Continuing with section 1.5.3 of paper 12, topic 1, where we're looking at an overview of fund management and managed funds. And this potential for future growth is the potential for growth of the fund management industry in Hong Kong. Long list, always attractive to examiners for a multiple choice question. So what is the potential for future growth in Hong Kong? Well, the rapid expansion of the mainland economy has led and will continue to lead to significant growth in foreign currency reserves, leading to opportunities for Hong Kong asset managers. Now, there's two schemes coming out of China that you should be aware of, and these can be examined. The Qualified Domestic Institutional Investors, QDII scheme, and that opens up channels for mainland entities to invest abroad. So the qualified domestic investors are in China and they are now able to invest abroad. And then we have the qualified foreign institutional investors, QIFI, and that allows foreigners to access domestic China securities. And then we have the Bond Connect that was launched in 2017. As you can, I beg your pardon, I'm jumping. So these two schemes have often popped up in a question, so be aware of the difference. Now we have the continued growth of the connects, the Shanghai Stock Connect, the Shenzhen Stock Connect, launched in 2014 and 16 respectively, and the Bond Connect came in 2017. Now these Connect setups have only grown, and it's a way of opening up the China market to foreign investors through Hong Kong. So be aware of those. The Wealth Management Connect, that was launched in June 2020, and this is all about the Greater Bay Area, where it is being encouraged for fund management to thrive and prosper in the areas of Hong Kong, Macau, and 9 Guangdong cities. And we have the continued growth of the mutual recognition of funds that was launched back in 2015, and that is where Hong Kong fund managers can invest in recognized funds in China and vice versa. Hong Kong, we're told, is ranked among leaders for hedge fund management in the Asia Pacific region, and that continues. And institutional investors, those are the investors that are the major investors in hedge funds. Who invests in hedge funds? Fund of funds, that's fund of hedge funds. Banks, insurance companies, pension funds, endowment funds, sovereign wealth funds will invest in the hedge funds. And efficiencies emerging from the development of the fintech industry. The fintech sector is considered to be further allowing growth in the Hong Kong fund management market. We then have an international perspective with regard to fund management in Hong Kong. We recognize that money is coming into Hong Kong from all over the world. There are no capital controls. And the last point there, Hong Kong is being promoted as a financial center for Islamic funds. Now, another examinable area is the benefit and costs of managed funds. So why would you invest in a managed fund as opposed to just investing directly yourself? Well, the benefits include access to professional investment management. So the professional investors are managing these funds. Diversification. Just by investing in one fund, you are automatically diversifying across a number of investments, maybe across a number of funds, because of the managed fund concept. You have access to greater investment opportunities. Some funds can get access to investments that retail investors could not. There are cost benefits from the asset managers being able to get access to volume discounts and access to the use of technology that a retail investor would not be able to do. Liquidity, with a lot of these funds, there's high liquidity. What does that mean? It means you can redeem your investment quickly and often on a daily basis. Convenience and support from service providers providing their support to the fund managers, and there can be tax benefits. But what about the disadvantages of managed funds? Well, cost. because you've got to pay for these fund managers. There's all manner of fees, front end, annual management, redemption, performance, and we're going to look at these shortly. You forego control because the decisions that are made as to what to invest in are made by the investment manager, not the ultimate investor. There is higher risk, certainly, than bank savings. And then pricing, well, the net asset value is determined at the end of each day. You don't see it through the day. You have to wait to the end of the day. And compared to real-time pricing in the markets, some see that as a disadvantage. So please be aware of the benefits of managed funds and the disadvantages of managed funds. Easy for an examiner to set a question. We continue on to section 2 of topic 1, paper 12, looking at retail and institutional managed funds. Now, funds can differ in many ways, but what we're doing in paper 12 is we're focusing on institutional versus retail markets. Institutional are the big institutions that are investing in funds. Retail markets are where individuals are investing in funds which are made available to the public. Now, with regard to size, well, retail investors have a significantly lower level of investment than the institutional investors. Private clients, high net worth individuals, tycoons possibly, they come somewhere between the institutional and retail investors. And the higher the amount you invest, obviously, the lower your fees, sort of bulk discount. Now, there are some aspects of the managed funds that we must be aware of. First of all, the offer document. Now, the offer document for managed funds catering to retail and private clients, that is known as a prospectus. Now, the prospectus has to be approved by the SFC before it can go out into the public markets. And this is a function of the SFC protecting retail investors. Institutional investors are professional investors. They do not require the same level of protection, but the retail, the public do. And that's why a prospectus for retail private client markets must be approved by the SFC before it goes to the public. Professional investors, including institutional, are exempt, just as I said, from these requirements. However, they do have to publish a document known as an information or explanatory memorandum. Now, as well as prospectus or information memorandum, if it's for institutional clients, the management company of the fund needs to also provide, and here we are, easy to examine this, last audited annual report, last unaudited semi-annual report, if that is relevant, a key fact statement, an application form, and other pertinent information. So that should also be provided in the offer document. Now, there are a number of fees and charges, 4 types: initial subscription or front-end fee, the redemption fee, annual management, and performance fee. And we're going to look at each of these in turn. And there's a table at the bottom of page 1.9 giving you the typical levels of fees for different types of funds. And you can see that the fees get higher the more sophisticated the fund. So if we move on to page 1.10, looking at the different types of fees, yes, could easily get a question on this. The initial subscription charge or the front end fee, and that's usually for retail funds. It's what you pay up front when you are investing in a fund. Fund house pay a large part of the fee is commission to distributors. So, and when they say a large, it's a significant amount of that initial fee will go to whoever distributed the fund to the end client. Now, a distributor may choose to rebate some of the fee back to the investor, and that will be an individual decision and something that's agreed upon when they set up the relationship. Institutional and most private client funds do not have front-end fees. So as I said, this is tends to be restricted to the retail market. And a bid offer spread, that's the difference between the purchase and the redemption price. Purchase will be higher than the redemption price, and that difference is the spread. A redemption fee, that's where funds do not charge a front-end fee. Applied to withdrawals made from a fund, usually not long after, or in relative terms, the investment's been made. It's also considered to be a contingent deferred sales charge. Now, does not normally apply to private clients' institutional investments. Investors switching between investment options in an umbrella fund, they pay a switching fee, not a redemption fee. Moving on to annual management fee. Well, it's just as it sounds. It's charged by the fund manager. It will be based on the size of the fund. It may include a trailer fee paid to distributors, and that's where the fund will continue to pay an amount to the distributor over a number of years, paid out of the annual management fee. Bond funds, we're told, have a lower management fee than equity funds. Institutional fund management fees are lower than for retail funds, and that tends to be because of the volume of business. Private client funds, they're priced somewhere in between the two levels. So just be aware of these. Do the practice questions. You'll pick up the pattern as you go through it. And as well as the annual management fee, a fund will pay an annual trustee fee. And then we come to performance fee, and this, we're into the world of the more sophisticated investments. It tends to apply, as it says, to alternative investment, strategy funds, hedge funds, and private equity. And more private equity funds are growing. And this is one of the incentives for the private equity fund managers, is the performance fee. Because if they make a very strong return for investments, they participate in the upside. And as it says, the last point on page 1.10, fee is charged when fund net asset value exceeds previous highest watermark and can be referred to as high on high or watermark. So what that means is that the performance fee will be a percentage of the increase over the previously highest net asset value. So that if the fund goes down below a previous high net asset value and then recovers to the original net asset value, there is no performance fee. The performance fee is only paid when you go beyond the previous highest net asset value.